I think it's time to say a few words about the US election that is coming up and how that affects the markets. In particular, I want to keep it very simple. This is not a political podcast. The purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. So let's leave it at that, okay? I'm not going to get into politics here. But as we are a hedge fund and we do trade in currencies, commodities, stocks, all kinds of things, we have to have a macro view. And the US election is boiling down into two directions. One is, let's call it the socialist direction. The other is the libertarian direction. Socialist being Harris, libertarian being Trump. And if we go the socialist direction, we will have almost certainly more government deficits. And if we go the libertarian direction, we might have similar problems with the government, although there is some hope that maybe Trump could actually even rein in on spending. He wants to appoint Elon Musk as a government efficiency official. So there could be some upside there. But let's just, again, we want to keep it very simple. We could have a little bit less deficits, but much more importantly, much less propensity towards redistributive spending, which is going to be just more better for the economy. So we have a scenario, Harris, where we have more redistribution, socialist policies, and therefore probably less competitive markets. Employment will stagnate. The government will take over more of the economy, so we'll have relatively good numbers in terms of jobs and things like that. But in reality, it's going to feel like a recession. And under Trump, because he's been there for 4 years, so we've seen, I think Trump talks a lot but doesn't do much. So it's a lot more laissez faire, much better for capital, and therefore much more bullish for markets. So in that scenario, how do we position ourselves? And I think we think that in a Harris scenario, you have a serious problem with the dollar and the bond market, and the best way to be positioned in a Harris scenario is just to be long gold. You can be long stocks too, because what's going to happen is a further erosion of the fabric of the U.S. financial markets through monetizing deficit by the Fed. And this is what I want to focus on here primarily, because some people have asked us directly, and there's a lot of talk in the market, well, the U.S., the bond market will collapse. It cannot sustain somebody like Harris and blah, blah, blah. That's not true. The way the U.S. bond market is set up, and that's what we're going to talk about in this particular episode, there is actually almost a security valve in the bond market where you really can't crush the bond market because the Fed is always going to be there to support the bond market. Now, there's some caveats there. I'm going to detail why, but there is almost a certain security valve. Certain meaning almost with close to 100% certainty, we have a system in place where liquidity and solvency will be just, risks will be taken over by the Fed, and therefore you can't really go against a complete collapse of the bond market. So if Kamala Harris keeps spending trillions of dollars more than she brings in, if she taxes the economy to the gazoo and people leave and does capital flight, we could have a really worst case scenario, and we could still have a functioning bond market, and that's because the Fed is backstopping the fund market through what's called a Standing Repo Facility. This is a Not Even Wrong podcast. It's August 20th, 2024. This is Krim Delco. Since the last update, we're up about 7%. The market is up 2% for the year. We are up 11.7%. The market is up 16.6%. We're underperforming by 4.9%. So let's talk about the mechanics and what this actually means for trading and for anything that has to do with the bond market. So the mechanics of the bond market in the United States are the following: that about 70% of Treasury securities that are traded on a daily basis, and this is a huge market, let's be clear about that, they're traded by so-called algorithmic traders. So Citadel, Millennium, and so on and so forth. Goldman Sachs, those types of people are involved. The actual mechanics are the following. So we have the Treasury that issues Treasury bonds. In other words, the Treasury borrows money from the market by selling bonds. They go to what's called the primary broker, which is Goldman Sachs. Could be Citigroup, could be Wells Fargo. Let's simplify it, just use Goldman Sachs. Now, Goldman Sachs, in the past, would probably take those bonds and then syndicate them to other banks, to pension funds, or keep them on their balance sheets. However, since 2008, the financial crisis, banks, in particular, dealers, broker dealers like Goldman Sachs, are restricted in the amount of balance sheet they can actually hold. In other words, they really are just intermediaries, and they can't hold a whole lot of inventory on their balance sheets. So they are forced to get rid of that stuff as soon as they take it on. Now, lo and behold, we have a solution for that, and it's called the hedge fund business. And what hedge funds are doing, in particular, let's just use Citadel as a proxy here. Hedge funds take those treasury securities and they continuously trade them between the future and the cash and the repo market. So there's an arbitrage to be made between so the same security can be in different positions. It can be in a cash situation. That means you hold the security. There's a future which mimics the actual value of the cash, but with a time lapse. And there's a certain formula and a certain arbitrage to be applied so that the value of that security is constantly being arbitraged in a risk-free way. And then there's also the repo market. I'm going to explain in a second what that is, which is a way to borrow money against your treasuries. And there's also an interest rate to be made, and there's certain prices that are driven by those interest rates that depend on how much demand and supply there is in the repo market. So there's this continuous arbitrage possible, and that's why algorithmic traders are in that market. Now, that's the official reason. I think the unofficial reason is, from what I just mentioned a minute ago, because investment banks are not able to hold a whole lot of this treasury stuff on their balance sheets. They have to dump it on the so-called shadow banking system, which is the hedge fund business, and they hold those securities. And they hold those securities with a lot of leverage, and that's how they make their money. And it's not surprising that when you go to Neureps, you have Waymo and Oracle and Microsoft advertising for talent, and then you have a whole 50% of the trade of the floor is actually taken over by Jana Partners and Citadel and hedge funds like that are looking for AI talent. And you might ask yourself, where is that coming from? Why is there so much AI talent that is being shipped to these hedge funds? And the answer is because the AI talent is being used for trading trillions and trillions of treasury securities. So it's a very profitable trade. And again, 70% of treasury trading now is happening in the hedge fund business. Now, why am I talking about all of this? Well, the key is the following. Like, if you have a situation, let's say hypothetically, where you could say, well, like, what if the Treasury keeps issuing trillions and trillions of bonds because of the deficits, right? You could then argue, well, at some point they're going to stop buying those bonds because they're just going to be bad investments. Well, the answer is no, that's not going to happen, because the hedge funds will always be taking the bonds. And why are they always going to be taking the bonds? Is because they can always, at any time, go back and get cash for those bonds through the repo market. The way that works technically is that if I'm Citadel and I bought a treasury bond, and for some reason I need cash or I have some sort of liquidity crisis or whatever, I can immediately go to Goldman Sachs and say, hey, I want to repo this. And they give me the cash and I give them the treasury. Now, I don't sell it to them. what's called repo. So it's like, think of repo like I give them the bond as a collateral and I get cash. Now, I just said a minute ago that Goldman Sachs cannot hold these things on their balance sheet, and that's true. So they can then go and use the standing repo facility of the Fed and immediately repo that same security that they just took over from Citadel and basically give it back to the Fed. So in any kind of situation where there's a crisis or some sort of liquidity crisis, in other words, people don't want to buy Treasury bonds, the Fed is there and it will always take anything that is being put to them. Now, why am I talking about all of this? I personally don't enjoy understanding the technicalities of the Treasury market. This is not how I like to spend my life as a hedge fund manager. But this podcast is about what it feels like to run a hedge fund. And I can tell you guys out there, anybody who wants to be in the business of trading anything in the markets professionally, better understand the techniques under which they're being traded, or whatever they're trading, whether it's stocks, whether it's options, or whether it's bonds. So you need to understand the actual technical situation of trading. And a lot of trading these days happens in high-frequency trading. In other words, hedge funds are the main bulk of the volumes that are traded. It's not Warren Buffett, it's not me, it's not CalPERS pension fund that is buying and selling all day long. It is Citadel and Jana Partners and others. Now, what that means is two things. One is there's always the risk of a blow-up. And second, the blow-up will be always taken care of, at least on the Treasury side, by the Fed. So the Treasury securities are, in a true way, and in a true, honest way, risk-free securities because they're not defaultable. Like, you can't default on this. The government's not going to default on this, and the liquidity risk has been taken out of the equation. Having said that, of course, there's always a potential for a short-term collapse because something goes wrong, particularly when you have high-frequency traders, because what they're really doing is what's called betting on mean reversion. In other words, they always look at some sort of average, and if the price is below the average, they buy, and if it's above the average, they sell. And sometimes, most of the times that works, but sometimes that doesn't work. And when that doesn't work, things go haywire. But with the Standing Repo Facility, the Fed has found a way to stabilize the market in such a way that it's very unlikely that we'll have some sort of blow-up. In other words, if you want to short Treasuries because you think Kamala Harris will become president and everybody's going to run away and the US will turn into Argentina, think twice. This might happen in the long run, but it's not going to happen anytime soon. So you're wasting your capital. In fact, you're going against the Fed, and that's not a good idea. Now, as a trade idea, and please don't take our recommendations here at face value, do your own work. This is not investment advice by any means. But I think we owe people a little bit more than just, oh, well, this is the technicalities of the market. So we want to just say, look, if you really think that we're going to decay into socialism and have this, perpetual deficit spending and gaslighting by the U.S. government under President Kamala Harris, you definitely save by owning gold or Bitcoin. But you can also buy stocks. Why? Because, look, the Argentinian stock market actually has done pretty well. Brazilian stock market has done okay. It's not that great because the corruption there is a bit higher than even a country like that you would expect. But nevertheless, what I'm trying to say is that, the good old Hugh Henry once said, look, I mean, you can buy, you can expect money printing to the gazoo, and the Dow is going to go to 20,000 and 50,000 and 100,000. And what that means is, in nominal terms, things can keep going well forever. And it doesn't mean that you're going to actually be wealthier. It doesn't mean that you're going to beat inflation. It doesn't mean that you can send your kids to school and college and buy your house and all of that, because that's what real wealth is, right? But nominal wealth, which is just the market can go up, like I mentioned, Argentina. If your stock market is up, whatever, 30%, but inflation is 50%, you're still up 30%, but in real term, you're obviously down. Okay, having said that, what we mean is that you can also buy stocks in an inflationary environment with deficit spending, as long as you buy the winners, because productivity and innovation and winning in the marketplace actually superstates even deficit spending and waste, at least in the medium term. If at some point this country collapses into civil war, then of course all hell breaks loose. But as long as the fabric of society is still intact in a way that we can go on the streets and mind our own business and get paid and pay for what we consume, things like that, and the law is being abided to and things like that. As long as all of that's given, it's very likely that you can, a stock like Tesla can 5x, 10x, and do well. So you can, but what you don't want to own is obviously cash. You don't want to own cash. Cash is not a good idea in a situation like that. So to summarize, we think that the upcoming election, is certainly a very interesting situation from an economic perspective. It's quite a bit of a bifurcation between laissez-faire and interventionism. Kamala Harris has shown as a VP under the Biden administration that she is totally willing to accept industrial policy, which isn't just a fancy word for interventionism and creeping socialism, and Trump has shown that he's willing to have a laissez-faire economy. So we believe that stocks will do much better under Trump. We believe that under Harris, you definitely want to own assets that can beat inflation, because inflation will be rampant. Gold's a safe one. Stocks are in certain ways better, but a little bit more risky maybe. But if you just look at the numbers, just pure numbers, let's say S&P 500 since Obama took power, I think has averaged about 14%. So definitely beaten. And we believe inflation measured by gold has been sort of in the maybe in the 9% range. So that's been real inflation, and I think that kind of reflects the canonical inflation gauge, which is the house that you want to live in, right? The house that you want to live in, the hypothetical house, or maybe the house that you're actually living in, doesn't matter. But the place that you want to live in has probably appreciated by about 9% per year, which over the last 15 years would equate to, on top of my head, maybe 3x, something like that. It's probably conceivable. Your kid's college education has gone up maybe 2x, so it's been less inflationary, and your healthcare costs have gone up maybe 5x, so a lot more inflationary. But overall, inflation is definitely in that sort of 9% range at least. And you've beaten that with the stock market. So stocks are fine. Gold has done well, not as good as stocks because it's less risky. It makes sense. And then you have Bitcoin, of course, done much better. But I would say Bitcoin is not just an inflation hedge at this point. It's also a disruptive technology. Certainly, we are very happy with Bitcoin. We own some Bitcoin, not in the fund. This is a separate account that we have. We do encourage people to own Bitcoin just because it's a great technology. It's a really fantastic idea, and it's working, and there's no reason to not own it. Maybe you don't want to own everything. I'm not a Bitcoin what's the word supremacist, or those people who believe nothing but Bitcoin. No, we still like to own productive companies, disruptive companies. The purpose of this podcast is the purpose of this hedge fund of Orange Capital Partners, of our hedge fund, is to invest in fundamentally new concepts and engineering practices and create wealth that way. So, Bitcoin's part of it. We actually did own Bitcoin. We did exit Bitcoin because we had to deal with leverage and things like that, and that was painful, but we had to do it. And we're fine. We reinvested our money in very, very profitable companies, and we're very happy with the way we are invested as far as future productivity and growth are concerned. So again, Kamala Harris doesn't mean you should sell everything and run away, but it does mean that we're going to have more inflationary environment, more interventionism, and a little bit more difficult operating environment. But macro, the beauty of macro is that it affects everybody. You will have profiteering, you will have companies that might take advantage of the situation, such as maybe Google and Meta, like they did in this particular cycle with Biden. But that's also, I wouldn't run into those stocks just for that, because very often, being in bed with a corrupt government is sort of a Faustian bargain. So I wouldn't necessarily bet on that either. So I think you just, the best you can do as an investor is always stick with productivity growth. When companies deliver 10 times better value at 10 times lower prices, they end up winning no matter what the environment is. And if you can't do that, if you can't analyze the world like that, I think you're much better off with assets like gold and Bitcoin that just are a good hedge against frivolous spending. Thank you.